In what could be a relatively quiet week for macroeconomics, not least because of the US Thanksgiving holiday weekend, the main top-down feature of this coming week may come from Europe in the form of two sentiment surveys, the IFO from Germany and the Courbe synthétique or synthetic curve from Belgium. Now remember that Christine Lagarde, the President of the European Central Bank, has been very strident in her view that there will be no interest rate rises for the foreseeable future from the current rate of zero. That includes 2022. Granted, the ECB has started to taper its Pandemic Emergency Purchase Programme, or PEP, and decrease the amount of monthly stimulus. But Mademoiselle Lagarde and her colleagues are also taking pains to say it's not a taper either. And the clear statement about rates contrasts with those from the Bank of England and the US Federal Reserve. Now, they are at least debating the topic of raising interest rates and the cost of borrowing, albeit at least to date, in a fairly pusillanimous way. Now, these two indicators should be useful as the debates over whether we are seeing inflation, deflation or stagflation and a recovery or a slowdown continues to rage. The IFO because Germany is Europe's largest economy, and the Courbe because it looks to have a pretty uncanny record as being a guide to the benchmark Euro Stock 600 equity index. And remember, Germany's DAX and France's CAC are currently trading at new all-time highs. The IFO is due on the 24th of November, the Wednesday, and the Courbe on Thursday, the 25th. Now in October, the IFO Business Climate Index for Germany fell for the fourth month in a row to 97.7. Respondents to the survey blamed supply chain problems and bottlenecks, and also falling capacity utilization rates at manufacturers, things that we've heard fairly globally. In October, the Belgian Courbe came in unchanged at 4. That left the indicator 12.5 points higher than a year ago, but some 6 points lower than its summer peak. Services industries were more optimistic, the building and trade industries less so, while manufacturing noted demand was broadly stable. Bottom up, there should be plenty of corporate news back here in the UK to study in the coming week, as interim or full year results and trading statements come thick and fast. Names which may be worthy of further study include the following, although again, do please note that some of these dates may be subject to last-minute change. Cars and Diploma on Monday the 22nd of November. CRH, Compass, Telecom Plus, Cranswick, AO World, Pets at Home and TT Electronics on the 23rd. United Utilities, Intertech, Johnson Matthey, Rotork and Britvic on the 24th. Mulberry, Hill and Smith, James Latham and Forterra on the 25th. And to round off the week, Reach and Mutchells and Butlers, on Friday the 26th. Now for me, the company though which may just cause the biggest fuss in the week ahead is Severn Trent. The utility, which provides water and water treatment services to around 8 million and 4.5 million households across the Midlands in England, it's scheduled to release its first half results on Tuesday the 23rd of November. Doctor Who's television birthday if you're really interested. Now, shares in the FTSE 100 firm have done nicely in the past year, rising 15%, and since June they've actually set a series of new all-time highs. Now, there are a number of possible reasons for this strong showing. Utilities can offer a degree of inflation protection, as their revenues and sometimes dividends often come with some degree of index linkation. Now, the shares also offer a respectable dividend yield of around 3.6%. That may catch the eye of income seekers as inflation rises and interest rates remain pretty much at rock bottom. The company also presses a lot of the right buttons when it comes to environmental, social and governance screens, thanks to its 6 green recovery projects, which are being partly funded by a £624 million award from regulator Ofwat and Spring's £250 million share issue. Now, Severn Trent has also issued its so-called triple carbon pledge, whereby the firm aims to generate net zero emissions, use only renewable energy, and have a totally electric fleet of vehicles all by 2030. Severn Trent also looks to be off to a pretty quick start in the AMP7 regulatory cycle that runs from 2020 to 2025. July's trading update and September's analysts meeting revealed that Severn Trent would rake in a better than expected £79 million in outcome delivery incentives, or ODIs, for beating key regulatory targets in the first half. Now, analysts will be looking to Chief Executive Liv Garfield for comments on all of those points and how the first half also stacked up relative to the company's guidance for the full year, which was given alongside last year's results back in May. Now, the key points of guidance offered by the board were an increase in sales of around 6%, higher operating costs even as COVID-related bad debts fall, thanks to upward cost pressures on energy and chemicals, with higher property sales and strong ODI results contributing positively. Now, that combination underpins analysts' forecasts for a double-digit percentage increase in adjusted pre-tax profit for the fiscal year against last year's £473 million profit. On a stated or statutory basis, analysts are looking for a 14% increase in stated pre-tax profit to £267 million. So maybe that rate of increase is a possible benchmark for these first half numbers. Another number to note is capital expenditure. This peaked above £800 million as Severn Trent got ready for the end of the AMP6 regulatory cycle, and it's forecast to come in between £550 and £650 million in the year to March 2022, and that includes the Green Recovery Project. Now, lower capex can mean higher cash flow, and higher cash flow helps to fund the dividend, always a key point for any utility, as their relatively limited growth potential means they tend to have to offer a juicy yield to compensate investors for any risks associated with holding their stock. Under AMP6, Severn Trent's policy was to increase the dividend by retail price index inflation, RPI, plus 4 percentage points. Under AMP7, the goal is less ambitious, to raise the dividend in line with CPIH inflation, which is the Bank of England's preferred measure that includes housing costs. Now, at the start of the fiscal year in April, that was 1.6%, even if it's motored higher since then. Management has guided to a full-year dividend of 102.14 pence, and that's against 101.58p last year. The first half payment a year ago was 40.63p, so I'm sure analysts and investors will be looking for a small increment relative to that. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next week.